All right, welcome back. We're going to finish up chapter 2 here, discuss the kitty tax, as well as some capital gains tax calculations. So getting back into it, children with unearned income. Children with unearned or earned income are required to file their own tax return if their standard deduction is limited to the greater of $1,150 or their earned income exceeds or plus 350 does not exceed the standard deduction. Kitty tax. If your kid is under 18 and 24 in some limited cases, some of the child's unearned income is taxed at the parent's marginal rate. This was put in place a long time ago to kind of curb um, asset transfers to children. You'd have grandparents and parents who would put money and stocks, dividends into to their child to avoid getting taxed at that. That's where the logic comes from, why it's taxed at the parent's marginal rate. It's less than 18, the kitty tax applies to unearned income greater than $2,300. So at 18, the kitty tax, if your earned income is less than one half of the support and unearned income exceeds $2,300. 19, but less than 24, um, kitty tax if you're a full-time student and your earned income is less than one half the support and your unearned income is greater than $300. Um, you don't see this a lot anymore, and it's because of the kitty tax rules. They get to be pretty harsh, and the reason for it was to curb that asset transfers. Gifting stocks and bonds to kids so they won't get taxed. Now they're taxed at the parents' marginal rate. And I've got some links, and it kind of goes into greater detail on the kitty tax. Like I said, you don't see it a lot anymore, and it's because these rules get to be pretty harsh and severe in some cases. So let's move on to the treatment of capital gains and losses. Capital gains and capital losses derive from the sale or exchange of capital assets. Capital assets are, they could be a house, a boat, they could be the stocks that you've got in your Robinhood account. Um, it's anything that you purchase, basically. And if you sell it later, you would have capital gains or losses. And there's a lot of exceptions to that. If I sell my personal vehicle for a loss, let's say I bought it for $10,000, decided I didn't really like it, sold it for five. I don't get to claim a capital loss of $5,000 because that was a personal expense. If it was a business expense, if I own a business and I had a vehicle in the business, then I would absolutely get that $5,000 capital loss. But with it being personal, you don't get capital loss. You get capital gains, but you don't get to claim losses. Net long-term capital gains are taxed at a lower rate than ordinary income. They do have a favorable tax rate, which is why they're very popular for people to have, stocks and bonds. Long-term is greater than a year. Net short-term capital gains are taxed as ordinary income. Short-term capital gains held less than a year. If I bought a stock for $100, and then I held it for a month and I sold it for $200, that $100 gain would be taxed at my marginal rate as ordinary income. Capital assets are generally trade, business, or investment property that are not inventory. And net capital losses are deductible only up to $3,000. Excess capital losses can be carried forward. That gets to be a real problem with, I see it a bit with people who, kind of fancy themselves day traders. Uh, there's a certain thing called a wash rule where if I buy and sell the same stock over and over and over, and I keep selling it at a loss, I don't get to claim that loss. I get to claim that loss when I'm completely clear of the position of that stock, and it's got to be for 30 months or for 30 days. that's where I see this a bit, with people not understanding tax laws, tax rules. So basically, they show this big income for 1 year because they kept buying and trading. And so then let's say they showed $1 million in income. Well, okay, in year one, you're going to be paying tax on that $1 million because you couldn't claim these losses. And then once you completely close out of your position, you can close it. And then, okay, you've got this big, massive loss, and you can only use up to $3,000 a year. I see some people with $150,000 in capital losses. They can't claim that at once. They got to claim $3,000 every year. They won't see the end of that. Very important to understand how capital gains and losses work. Maximum net capital gain rates. Capital gains can be taxed at the following maximum rates. You got 0%, 15, or 20%. These are the favorable rates. This 20% would normally be in the 37% bracket if it was ordinary income. Here we're looking at 20% for capital gains. It's a favorable rate. And then finally getting into tax planning considerations. This is the kind of fun stuff. Shifting income, maximizing itemized deductions, married filing joint versus separate, splitting income. The married filing joint versus filing separate, I kind of want to draw attention to because that's where it gets to be kind of, there's some unique situations that I want to let you know. Typically, married filing joint is almost always going to be your preferred option. The exceptions, I can think two particularly popular ones are if you have one spouse with a substantial amount of income and one with lower, so say we're here and here, and this spouse has a lot of medical expenses, right? So but let's say they have $10,000 in medical expenses, but they don't get to use any of that because their income gets combined with this other item. So people will do married filing separate, where this is his income, this is his income, or income. And the medical expenses are calculated off of this as opposed to both of them combined. The other one being student interest, student loan interest. The PSLF, Public Student Loan Forgiveness. You've got people down here with a lot of debt, but they're in the public service industry. We got someone, here or here, it doesn't really matter because their income all gets added. When you do married filing separate, you've got the PSLF, which you don't know. You're the student, you're in the public service industry, I think hospital workers. You would have to make payments on your student loans for 10 years and then it's forgiven. And the amount of the payment gets calculated off of your income. Well, if your income's here, that's better than if you're combining it with someone else. So people do married filing separately to lower that amount. And then after 10 years, it's forgiven. So in 10 years, you would get a greater amount forgiven doing married filing separately than joint. All right, and that's what we've got for videos for week 2. All right. Thank you for tuning in, and I will talk to you all soon. All right, thanks. Bye.